We start off with the most important chart in the market, according to one of our traders. T-bills versus the semi-spill. Over the last 5 days, bond prices have rallied, with the yields in the 10-year dropping below 2.8% today for the first time in over a month. Meanwhile, the SMH Semiconductor ETF has plunged down 9% just this week, far outpacing the losses that we saw in the broader markets. So, Rosso, we point to the SMH is very important all the time, and the declines in yields, I mean, they were just breathtaking this week.
Yes, they were. And if I look at yields on a basis going back to November 2018 to the highs of June, basically 2022, the 50% retracement for yields is 2%. The reason why I bring that up is that those two dates, the 2018 date and the June 2022 dates, that looks like to me a double top for yields. So I do think we're going to get a respite as we've seen wheat prices come in, gasoline prices come in, commodity prices come in on a monthly basis, not as a whole. So I don't think we're out of the woods there yet, but I think we're going to give enough to Jay Powell to maybe take his foot off the gas, and you're going to see yields come in from here.
Tim, you're actually the one who brought us this important chart of the week. So what does this signify to you?
Well, I feel like it's a broken record in terms of the importance of the semiconductors because of their cyclicality, because of their epicenter dynamic in terms of supply chain and also inventory dynamics, over-ordering, under-ordering, et cetera. But look at the underperformance of the SMH, or the SOX Index Semiconductor ETF. 4.5%, almost 5% to the S&P today. So stocks were up. You had a sense that there was actually a decent start to the quarter today, but it really wasn't. And if I look at semiconductors, the underperformance to the S&P in the last, call it 20 days, is about 13%. Again, to an S&P that's been down aggressively. This is how much the semiconductors have underperformed, and it's in stark contrast to the rally in bonds. And obviously, they're the same story. It really is facing the recessionary risks head on. What we've seen in the last 3 days, as referenced with the 10-year, going from 350, we're at 280 on the lows today. Obviously, bonds didn't finish at those low on yields, and they actually rallied back a bit in terms of yields move higher, bonds sold off. But it was really an ugly, ugly day. And we pointed out this week, and I think we're going to continue to point out, it may be okay to see those interest rate sensitive stocks rally, especially mega cap tech stocks on a day like today, and they will carry the market. But what I saw today was pretty ugly. And I think the move in the semiconductors is downright scary, because that talks about the real epicenter of the economy.
I mean, within the S&P 500, the moves were defensive. Within this rally, we saw the biggest gains in utilities, for instance. We saw a rally in the bond market still, Courtney. So what do you make of all this, especially in light of semiconductors signaling? The latest data point is from Micron. They just talked to investors in early June, and they said that things are worse today than they were at the start of the quarter. Then they talked to us yesterday, effectively, with their guidance, and said things are even worse than that.
Yeah, and I think you're seeing this across multiple platforms, right? You're seeing consumer spending is coming down. You're seeing the manufacturing index is coming down. And Tim brings up a really good point here, that if we follow his logic, that some of these semiconductors are leading to the idea that the economy is slowing down here. It's one of those ideas that really good news for the economy has been bad news for the stock markets, but maybe now the opposite, where some bad news that the economy is actually starting to slow down is what people want to see here, and that the Fed is going to start to hopefully ease on their rate hikes, which could inevitably be a good thing for the market. So I think this actually could be one of those good news, bad news scenarios, which is inevitably maybe good for the markets.
Pete, do we get a respite? Do we get a respite in terms of selling, particularly in tech names, because of this pullback in yields?
Well, I tell you what, the very first thing I look at each and every day, Mel, is the yields. And I look at the 10-year and the 2-year. And if I see them, especially right now, obviously, as we've dropped underneath 3, and I want to see what kind of an acceleration we have on that drop. And that obviously transfers over to the markets pretty quickly. As a matter of fact, in the last 3 hours of the day, that's when we had all of the big gains that we were looking at today, as a matter of fact. You look over at the Dow up 300 points in the last 3 hours. You look over at 160 points on the NASDAQ. So that really did flip things around very, very rapidly. Real quick on the semiconductors, this has been going on for a month. This is not just the 1 week thing. The 1 week has been awful. but they've really been struggling for a while now. And then obviously with the Micron news today and some of that, what was forecast, there's a lot of nervousness out there. I think Tim's 100% right on this one, and I continue to look at that. We have seen put buying across the board, not just in the individual names, but on top of the individual names in the SMH as well. And they're not just going short term, Mel. A lot of them are, but most of them have actually been moving out in time, all the way out as far as September and October. So it's pretty interesting to see what we were seeing in the options market and how that's playing out right now in the markets themselves. But, you know, I still do need to point out 7 or 8 of the biggest sectors actually finished up 1% or more today. So it was a pretty broad-based move to the upside. I realize tech really did struggle, but everything else just seemed to be off to the races.
Yeah, Steve, you wanted in?
Yeah, so to Pete's point, so I've been negative on semiconductors for a while now, but the problem is only Micron is below the February 2020 level. So if I'll give you a point of reference. If NVIDIA has to get down to that 2020 level, it's going to have to be cut in half. That is a big move. All right, we're talking about 50% move down. Now, the SMH, the two top names, TSM, Taiwan Semiconductor, and NVIDIA account for about 20% of that index. So TSM is not as bad, though, but it still would have to be chopped up maybe 30% to get down to that February 2020 level. This is a matter of wanting to see the pull forward of these semiconductor names. So there's a lot of room to the downside, and we're going to have to dip down. We didn't even talk about the ISM levels here, or we're looking at June 2020 levels for ISM and May 2020 levels for ISM new orders. The S&P was at, during those levels, if we push the S&P back, you're looking at between 2,800 and 3,100 in the S&P. So overall, we've got to chop a lot of wood before we're calling bottoms in the overall market.
I have a question about the baseline, though. Why does the baseline have to be pre-pandemic? Like, why does it have to be February 2020? Why that baseline, Tim?
Because we're...
Grasso, why that baseline?
Yeah, I'll give you just a small snippet. We were in an environment at that point where we were not in a rising rate environment. So you have to flip the script. We had a huge tailwind to the overall market, a huge pull forward for semiconductors, hardware, everything across the board. But you have to go back because we're in a rising rate environment and everything is calculated on discounted cash flow. That's why technology stocks will run when rates are low and not when they're in a rising rate environment.
Well, then that's depressing, because that'd be a lot of wood to chop below on the S&P 500, Tim.
Yeah, I mean, Paul Bunyan here, and I think part of that Feb 2020 dynamic is okay. That was. We talk about companies on a 2 or a 3 year stack. So we get back to February of 2019, and you're looking at companies within the context of normalized earnings to that point. What's relevant is I would make an argument, we could argue, that we are in a period of secular stagnation. We were still coming off that period where the Fed seemingly overstepped its bounds, tried to raise rates in the fourth quarter of 2018, December 2018. We all knew where we were on Christmas Eve with the stock market down 20% that month. But the rally from, I don't know, September, October, November of 2019 into that Feb 2020 level was also pretty extraordinary. I would make an argument, and this is where you get into Paul Bunyan territory, is that Feb 2020 is not even the right level to look at. That's an environment where there's zero inflation and where rates are at zero. Should equities be valued in the same context as that moment in time? And I'm not sure. Yeah.
So then should that baseline actually be lower?
Yes.
Yes. Okay. So it's even more depressing.
More chopping.